The US non-farm payrolls came in better than expected by smashing estimate, and it rose to 180K jobs added last month of December. But what's interesting over here is that we do not see a major movement in the FX market and as well as in the major US stock indices. Very interestingly, the US dollar didn't strengthen, and in fact, it remains below resistance. A yo-yo session in the major US stock indices where the Nasdaq 100 managed to inch out a marginal gain, but with the other two remaining major stock indices, the Dow Jones Industrial Average and the S&P 500 remains supported. And this is due to the fact that Fed funds futures continues to price in at least 2 interest rate cuts to come in 2026, despite the stronger than expected non-farm payroll data that was released yesterday. Very good morning to all, and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here. So before we kickstart, let's have a quick look at the disclaimer first. As usual, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so here we go. All right, so very quickly, let's have a flash on the disclaimer slides. All right, so let's kickstart what has taken shape yesterday. So yesterday, the most important data for the global markets will be the non-farm payroll data. So something I want to share with you on the non-farm payroll data is, yes, despite we have this headline number that came in above expectation over here. So the economy added 130K payroll jobs added. So pardon me, just a while ago, I make an error. I said it's 180K. It's 130K jobs added for January. So that was much more higher than a downward revise for the 8K rise in December and came in well above forecasts of 70K. And this figure is the highest since December 2024. So that is almost a year high over here. But however, December print was the last print for, put away that the January print was the month where the statistics board in US will do a recalculation for the entire year of 2025 monthly jobs data that was reported previously. So after they do another revision over here, they found out that the total, okay, let me put it in, let me expand it you guys to see. All right, so yeah, so meanwhile, the total non-farm payroll employment growth, that means the total jobs added for the entire year of 2025, given the fact that they actually did another what I call a true-up revision for usually when they release for the month of January, they will do a revision for the prior year, which is from the previous year of 2025, was actually revised downwards from annualized 181K jobs added from 584K jobs added. So you realize that previously it was at plus 584K, that it was revised downward drastically to 181K jobs added for the entire year of 2025. So that only implied an average monthly jobs gain of only 50K jobs added. Okay, give me that 50K jobs added, way below the previous reported of 49K jobs added. So with that is one of the reasons why the US stock market didn't plunge drastically and the dollar didn't rally significantly because of this downward revision in the prior year, which is the entire year of 2025 total jobs growth, which was actually revised down significantly. So that has already been expressed by the futures by the traders in the US Treasury markets over here. So let me share with you the chart of the US Treasury market, which is the 2-year Treasury yield. So the 2-year Treasury yield is being used as a proxy for future forward-looking Fed monetary policy stances. So if you look at the 2-year Treasury yield, yesterday it did rally initially, but it still kept below the 50-day moving average, and it can't break out above this medium-term / major range resistance of 3.65 over here, what we could see on the charts. Okay, give me a minute, let me, all right, 3.63% over here. All right, and with that, it still continues to trap within this range configuration, and that also is being implied by the much more shorter term Fed funds futures traders, Fed funds futures market implied by calculated by the CME Fed Watch 2 over here. We continue to see yes, even though market continues to price in no cut for the upcoming meeting on the 18th of March, which is a very high chance to stamp at 95%, which the Fed will maintain the Fed funds rate at 3.5% to 3.75%. If you look at the aggregated tab over here, we continue to see market pricing in at least 2 interest rate cut before 2026 ends. So the potential fourth cut in this ongoing interest rate cut cycle that kickstarted in the later part of 2025 last year, where in total the Fed cut 3 times. So the fourth cut, market going to price in to come in the summer months of this year. So it's either 17th of June with a higher chance of 95% coming in on the 29th of July 2026 FOMC meeting. Okay, so hopefully I think the screen should be good. All right, so let me just do a check again. So hopefully the thing is not being frozen or something like that. Okay, 1 second. Give me a couple of seconds. Let me do a check. Yeah, I think the screen should be fine. Yeah, it should be all good. Yeah. So the where was I? Yeah. So the higher chance the market, the Fed funds rate market is looking for the Fed to continue cutting interest rates potentially, but the fourth cut will potentially come in the summer months of 2026. So it's either 17th of June, which is a 68% chance. The higher chance will be at 95%, coming in at the 29th of July at 3.25%, and to bring the Fed funds rate lower by 25 basis points to 3.25% to 3.5%, despite that headline non-farm payroll data for January that came in way above expectation. And also looking for the fifth cut to come into the later part, either Q3 or Q4 of this year, with a 75% chance on the 16th of September 2026 FOMC meeting, and with an 83% chance coming in on the 28th of October 2026 meeting. So eventually by the end of the last meeting of 2026, which on the 9th of December, market participants have a high chance of 90% for the Fed funds rate to be at 3% to 3.25%. So that concludes to us that the market participants in the Fed funds futures market, the market participants in the US Treasury 2-year note are still looking for a potential continuation of this interest rate cut cycle for the Fed, except the fact that the interest rate cut may not come so soon. It only come in the summer months, and then thereafter there will be another cut, which is only potentially 2 interest rate cuts so far that's being priced in to come in either Q3 or Q4 of this year. So that actually allows the US dollar to continue to trade on a weaker side of the story. So this is the 5-day rolling performance of the US dollar against the other major currency. So initially we see a spike up in yesterday's US session. After the spike up, the dollar strength dissipated. So if you look at the 1-day rolling performance right now in Asia, as we are speaking, at 11:12 a.m. Singapore time, the dollar is the weakest against the Japanese yen, which came in within our expectation as well, down by negative 0.5% as we are speaking. And following the pack, the dollar is the weakest, second against the Kiwi, down by negative 0.3%, and also against the Aussie dollar, down by negative 0.2%. So across the board, we continue to see the lack of US dollar strength so far, despite the non-farm payroll data that came in way above expectation on the headline number for January. And going forward with that, if you were to look at the price action chart of the US dollar index, which I tend to use as a gauge for general dollar strength or general dollar weakness, we continue to see a bearish reaction after the spinning top candlestick that is being formed yesterday, which the price action almost closed unchanged at the from its opening price from Asia session yesterday. So it closed almost unchanged after the end of US session, and in today's Asia session, it has a negative reaction, down so far at negative 0.11% as we are speaking right now, 11:13 a.m. Singapore time. So all in all, we continue to see a bearish reaction in the US dollar index, still trading below the downward sloping 20-day moving average. So potentially it could en route to retest the swing low that was being seen on 27th of January 2026 around last month, which is a month ago over here. So indicating that the potential near-term downside momentum and as well as the medium-term downtrend phase of the US dollar still pretty much remains intact over here. Then onward next will be the performance of the US stock market over here. So the performance of the US stock market was rather yo-yo in yesterday's US session. So by the end of the US session, you have the SPX 500 close almost down slightly, negative 0.34%. The Nasdaq 100 is the one that managed to stage a positive return by the end of the US session, up 0.29%. And the Dow Jones Industrial Average closed down slightly lower at negative 0.13%. And the Russell 2000 was the worst performer yesterday, down negative 0.38%. So overall, if you look at the heat map of the S&P 500, we do not see across the board risk off a scenario. In fact, a bit of mixed bag performance you spread across the industry over here. So we see the tech several patches of green in the technology sector, led by the semiconductors, where NVIDIA managed to up by 0.8%, Broadcom AVGO up by 0.7%, and Apple almost the same magnitude, up 0.67%. And we also see a slew of green in consumer defensive, industrial, real estate, utilities, and in some form of the healthcare and most importantly energy stocks continues to outperform, given the fact that oil prices continues to remain firm, and also due to this kind of a expansionary expansionary foreign policy that's been undertaken by the US administration. So that causes the energy prices to remain rather firm right now. All right. So if you look at the then the underperformer comes from the financial sector, the financial stocks yesterday. So if you look at the grouping based on the 11 sectorial performance of the S&P 500, energy continues to come in as a star performer yesterday. Energy was also a star performer in the last 2 to 3 sessions ago. So energy up 2.5%. Basic material also up by 2% over here, given the fact that all these are pretty much driven by the current stance of the expansionary aggressive foreign policy undertaken by the US White House administration. Consumer defensive up 1.33%, followed by utility up 0.87%, and the industrial up by 0.77% over here. All right, so yesterday underperformer was the communication service and the financial sector, down by negative 2.1%. And almost the same, all right, which is the financial down negative 2.4%. Okay, so if you look at the Asia markets today, so the Asia markets today, no much major movement except the fact that we have some profit taking in the Japan 225 over here. So the Japan 225 yesterday was actually closed for the so-called the Japan public holiday. So the cash market today opened almost unchanged. But if you look at the futures market, that is kind of trading almost like a 24-hour market, not really 24, I'll say it's a 23-hour market. Now down slightly, negative 0.88% due to profit taking. And we also see profit taking on the Hang Seng Index as well, down by negative 0.9%. And the CSI 300 Index, which is the China A shares market, comprises of the 300 big cap stocks listed on the Shanghai and Shenzhen stock exchanges, almost unchanged, 0.07%, and the smaller China A50 shares down slightly by negative 0.35%. And across the other Asia market continues to bask in the bullish limelight. The Australia 200 up by 0.55%. The Singapore STI finally broke above the psychological 5,000 level, now trading all-time high at 5,017, up by 0.64%. So overall, if you look at the across the board in general for the Asia Pacific stock market, it's much more of a bullish tone rather than a bearish tone as we are speaking right now, due to the fact that the US dollar continues to the US dollar strength continues to remain absent in the FX market right now. All right, so now let us now move very quickly to the second segment of the daily dose over here. So the second segment of the daily dose for today, I will just cover more of the charts of the day, given the fact there's no much movement on the indices that we covered yesterday. So let me touch on firstly, before I go to the charts of the day, let me touch on the updated levels first for the major US stock indices. All right, so starting with the S&P 500. So let me expand the screen so that, no, starting with the Dow Jones Industrial Average, pardon me. So let me expand the screen so that you guys could see. All right, good. So I think the screen should be showing. So let's start with the US Wall Street 30 first, which is representing the Dow Jones Industrial Average. So the US Wall Street 30, we do have a bullish bias previously. Price action hit our first resistance level again, which is 50,532. So this 50,532 was tested on Tuesday. And during Wednesday's US session, it almost tested as well again, printed a high of 50,513 before trading that minor pullback. And what's interestingly, this minor pullback managed to help exactly at our right above our Titan pivotal support that we mentioned earlier on. So indeed, this is indeed a pivotal support to maintain any bullish bias that we still that's still intact on the US Wall Street 30 in the intraday basis. So for today, continue to watch this 49,880 short-term pivotal support on the US Wall Street 30. First resistance for sure will be at 50,532. Above 50,532, potentially could expose the next intermediate resistance on the intraday basis, 50,695, which is the next Fibo extension level, and also sorry about that, and also the ongoing upper limit of this medium-term ascending channel that is still in play since the low of 23rd of May 2025. However, if price action didn't push up as intended and erratically break down with an hourly close below 49,880, then this direct bullish bias view today on the US Wall Street 30 will be invalidated to see another round of minor corrective decline to retest the next near-term support level at 49,606, which is a very key former range resistance now turns into a pullback support level to watch for the boost, because previously it's from 7th of Jan all the way up to 4th of February, pardon me, it faced 1 month pass of resistance before breaking out on last Friday. So typically 49,606 will be a very, very key psychological level to maintain the bullish bias. So once price action level hit 49,606 or very near to it, I'll be on the lookout for a bullish reversal price action to maintain my bullish bias stance again. Maximum allowable for the minor corrective pullback to take shape will be around 49,265, which confluence with this turning up 20-day moving average. So that's for the US Wall Street 30. Next up will be the S&P 500. So S&P 500 also managed to bounce exactly at our first support zone that we highlighted previously, 6,932, 6,916, which confluence with the 20-day and the 50-day moving average very closely. So without doubt, I don't want to tighten the pivotal support to be so tight at 6,932, 6,916, because it still can't clear above the first key resistance zone, which is the current all-time high area at 7,005, 7,014. So pivotal support still remains the same, 6,877, 6,860, unless we still see a clearance with an hourly close above 7,114, then I will tighten my pivotal support to 6,932, 6,916. Next resistance level to watch after 7,014 will be at 7,038, 7,045 on the intraday basis. However, if price action break down below 6,877, 6,860, then this bullish bias will be invalidated to see a choppy corrective downward drift to retest 6,797, 6,769 again. Lastly will be the Nasdaq 100. So Nasdaq 100, the movement is almost very similar to the SPX, managed to survive at our first intermediate support zone that we highlighted, staged a bounce yesterday after the reaction off from the non-farm payroll data, 25,084, 24,981 over here. So it still can't break above the 20-day and the 50-day moving average, which is this intermediate resistance level at 25,430, 25,580. So unless we have a clearance above 25,580 today, then I would tighten the pivotal support to 25,084, 24,981. So for that, Pivotal support still remains the same, 24,700, 24,580 for now on the Nasdaq 100. So unless we see a breakout above 25,580, then potentially we may seek out the next intermediate resistance level, which is the minor swing high of 30th of January and 3rd of February before that much more steeper minor corrective take place previously before hitting the bullish reversal low last Friday. That is 25,940. Breaking down below 24,580 will invalidate these bullish bias to see a choppy downward drift again to retest 24,333, maximum 24,142. All right, so that sum up the updated level of these three major US stock indexes. So let us now proceed with the chart of the day. So the chart of the day, like I mentioned, will be covering the FX market given the continued downward drift in the US dollar strength. So the first chart of the day I will share with you will be the Aussie dollar over here. So the Aussie dollar today, it did a test on our first resistance that we previously highlighted at 71.40 over here, tested in the last 2 hours as we are speaking. All right, now it's at 11:24 a.m. Singapore time. So given the fact that yesterday we see this bullish hammer hourly candlestick appearing right after the release of the non-farm payroll data, so almost hit our form right above our Titan short-term pivotal support that we highlighted previously, 70.65. All right, printed a low of 70.71 or 70.72. So indeed, this is a pivotal support in order for the bulls to maintain its bullish trajectory in short term on the Aussie dollar. So unless right now we have an hourly close above 71.40 because it has been tested in the last 2 hours, can't break above it yet. I do not want to tighten my pivotal support to be so tight at the first intermediate support that we highlighted previously at 70.90. Unless we have an hourly close above 71.40, then I will tighten it to 70.90. So for now, still maintain my bullish bias with the same pivotal support at 70.65. So above 71.40, potentially will seek out the next two intermediate resistance level at 71.75, followed by 72.10, 72.19 next, which is a bunch of Fibo extension cluster level. And if you do a steepen minor ascending channel from last Friday bullish reversal low over here, okay, that also confluence with the upper limit of this steeper minor ascending channel drawn from the bullish reversal low on last Friday. Only a bearish breakdown below 70.65 that would invalidate today's bullish bias view to see another round of minor corrective decline to revisit 69.98, which is close to the 70 figure level slash 69.78, which is the pullback line of this former minor descending trend line previously drawn from the high of 29th of January. And if we do the Fibo retracement from that bullish reversal low last Friday all the way up to today's intraday Asia session high, which is 71.47, that also coincides with the golden ratio of 61.8% Fibo retracement. Right, so that's one of the chart of the day, Aussie dollar. So the next chart of the day, also pertaining to FX market, will be the dollar yen. So dollar yen, we are within our expectation continues to plunge lower, now breaking below 52.76. All right. So what we could see over here yesterday, we highlighted an updated level. So this will be the bearish reaction level that indeed takes place. Didn't break above the 154.73 Titan short-term pivotal resistance and continue to shape a series of lower high. So indeed, that was a tipping point for the minor corrective rebound to end. And right now, since it's breaking below 52.76, so it's prudent for me right now to tighten my pivotal resistance level over here. So what I'm going to do is I will tighten it to 53.85. Okay, so let me do some updating given that the price action has really now an hourly close at the 10 a.m. mark Singapore time hour, breaking below the 52.76 support level that we highlighted previously. So it's prudent for us now to tighten the short-term pivotal support in this ongoing bearish impulsive movement potentially that is still playing out on the dollar yen. Okay. Okay, so this will be next. Okay, so net overall tightened my short-term pivotal resistance on the dollar yen to 153.85. Continue to maintain that bearish view on the dollar yen. Next support level to watch will be 5190/60, which is the 23rd and 29th of October 2025 lows. Breaking below it exposes 5120 next. However, if we start to see a push up above 53.85, then potentially we may see another dead cat bounce again, retesting 54.73. Only a breakout above 54.73 will see a much more deeper dead cat minor corrective rebound to revisit the 50-day and the 20-day moving average at 55.66, followed by 55.66, followed by 56.36 over here. All right, so that sum up the second segment, which I introduced to you guys the updated level on the 3 major US stock indices that we covered, and 2 charts of the day pertaining to the FX market. One is the Aussie dollar, then followed by the dollar yen, which you are seeing right now on your screen. So now, before we go, let's have a quick look at the economic calendar. What are the key data to look out for today that could potentially influence the markets over here? So let me reduce the screen. All right, so today will be the Thursday over here. So going into the European session on Thursday, we do have 3 p.m. Singapore time, which is the UK preliminary Q4 GDP growth rate for last year over here. So that could potentially influence the sterling dollar, the sterling crosses, and in some form the UK 100 CFD index. So that will be 3 p.m. Singapore time. Then thereafter, we have one ECB official speaking, ECB Sepolon, at 5 p.m. Singapore time over here. Then we do have a tier 2 US job market data. This is much more erratic because it kind of released weekly basis over here. So they have this initial jobless claim data for the week of ending 7th of February up at 9:30 p.m. Singapore time. So that could influence the FX market as well, the major US dollar pair, and also the major US stock indices. So that is 9:30 p.m. Singapore time. And at 12 a.m., we have ECB Marchando speaking over here, ECB official. Then 2:30 a.m., another ECB official speaking, ECB Lane. And for those who has interest in the dollar, Canada dollar, 2:45 a.m., we have Bank of Canada official speaking, BOC Rogers over here. And that pretty much sum up today's, we call it segment. But before I go again, there's one data which is pretty key before the start of the, we call it daily dose tomorrow at 11 a.m. At 9:30 a.m. on Friday the 13th, tomorrow, we have one tier 1 China data that market participants will be having a close eyes watch on, will be the housing price index for the month of Jan. So previously, it continues to decline at negative 2.7%, and trading economics team forecast the decline to be lesser, negative 2.6% year on year. So if there's some improvement in the housing price index, it could potentially fit to a positive feedback loop into the China, Hong Kong stock market. So something to look out for before the start of our daily dose tomorrow at 9:30 a.m. Singapore time, Friday the 13th. So with that, let's sum up today's daily dose of market insights. I'm Kelvin here, signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.